Okay, welcome everyone to our January 25th, 2011 FXDD co-production with FXStreet.com. Very glad that you are all here today. It looks like we have got a full house and we are ready to do another great training. Our disclaimer is we do not offer, buy, sell, or hold information. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle when you're trading in the Forex. All right, so today's class, this is an interesting one and a very important one. Greg's going to talk about whatever you do, don't blow up your account in 2011. We're going to be talking about risk and protection strategies, things that you need to know as new Forex traders. And again, what a great form to be doing this in. All right, so there's Greg Michalowski on the left. He's our chief currency analyst at the company. Many of you know him from his speaking engagements around the world and the work he does every day on our commentary pages. You can get Greg there on his Twitter address. Myself, I'm Sean Powell, National Training Director at FXDD. I'll be along for the ride and typing in the chat, helping you guys out with questions while Greg presents. All right, so if you want to know more about Greg, you can go to blogs.fxstreet.com/trader-link. That is Greg's home on FXStreet.com, and he's also someone that provides commentary on FX Street. So without saying, before we start, we do still have our FXDD.com promotion running on right now. That is our demo dollars promotion where you can actually convert demo account gains into real money. You can go to fxdd.com/fxstreet.com for all details on that. Now, without further ado, let's get the ball rolling. I'm going to pass the stage over to Greg and wish him good luck. Thanks, Greg. Go for it.
Here we go. I'm going to start off with a little PowerPoint. But today, as Sean introduced the show, it's going to be on Don't Blow Up in 2011 is our theme. And I always have to remind myself at the beginning of the year that is of mine perhaps one of my resolutions for 2011 is make sure that I in fact do not blow up the account that just causes a 10% or 12 or even 15 or 20 or that type of percentage loss on a single trade. And those are the types of trades that just put you so far behind. If it happens early in the year, you probably never recover. If it happens later in the year, you're probably, just kicking yourself for doing it at that year, because we all keep score from year to year, from calendar year basically to January, or most of us do. As a result, you always want to see what those results are at the end of the year, and if you just want to make sure that you don't blow up. So it is if you want to be a successful trader in 2011, you have to ask yourself, how can I end the year with more money than I started? And that's ultimately the goal. And if you avoid the blow-ups, it's going to be much easier to reach that bogey, to make money in your trading account. The fact is, folks, and you can see the statistics on the NFA site now, is that there's a large percentage of traders who lose money on a month-on-month basis, this business is not easy. It is not easy, and so you have to make sure you take it seriously and treat it like a business, and make sure that you don't blow up your account. So I have 10 ways and kind of goals, I guess, that will allow you to maybe remind yourself on what you're trying to do during the year, and to ensure that you don't have those opportunities where you're going to be losing 10, 12, 15, maybe even 20% on a single one trade. And so I'm going to list them 1 to 10. They're not necessarily in any particular order, but we're going to be going through each of those reasons and discuss them a little bit here in our webinar today. And then if you do want this webinar, you can always send me an email at greg@fxdd.com, and I'll be happy to send you so you can remind yourself each and every day what you're trying not to do in your trading account. So the first way to not blow up your account is a simple one, and this is and it actually is combined with number 2 as well. But the first goal that I'm going to try to make in 2011 is to be right only 50% of the time. Only 50% of the time. That's my bogey. That's what I'm going to try to do in 2011. Is set a low. Some may consider a low bar, only being right half the amount of times in my trades. And the key, of course, is that the quality of the wins have to be greater than the losses. That is, and this is a big but as well, is that you have to make your winners bigger than your losers. You only have to be right half percentage of the time. But if your wins can be greater than your losses, you are going to be better off at the end of the year, and you're going to make more money. So that gets to number 2, and I said they were combined. And what number 2 is that you have to risk a little. You have to risk a little and make a multiple of a little. In trading, I'm not one to necessarily believe that you have to go out there and be a hero and risk 100, 150 pips, 200 pips on some longer-term projection of what you think the euro or the sterling or the dollar yen or the dollar Swiss or any of the combinations of currency pairs might do. If you risk a lot, guess what you have to make on the wins? A lot. Okay? And I consider a risk of 100 pips to be a lot on trades in the foreign exchange market. It's very hard, especially for retail traders, to stay in those trades that potentially can make over 100, 150, maybe 200 pips. Now, think of it in the other way. If you risk a little, let's say 15 or 20 pips on a trade, what is a multiple of that little, of that amount? It's only 30, 40 pips, maybe, and it's much easier to think in terms of making 30 or 40 pips on a trade in something like the euro versus U.S. dollar, the sterling versus U.S. dollar, than it is to think about making 200 pips on a trade, a multiple of what you may be risking. So I've always taken the stance that I want to risk a little, but I want to make a multiple of a little. And that multiple, if you get the right trade location and you use the right tools that allow you to get that good trade location, can be pretty simple at times. You can, and an example would be this sterling versus U.S. dollar. We were talking about this before the show, and someone had mentioned that, did you go long the sterling? What was it? What was the exact comment? You didn't go long the sterling versus U.S. dollar earlier today, didn't you? Didn't you? Laughing out loud. And the question is, well, actually, I was asleep. But for those people who may have been involved in this market here in the sterling versus U.S. dollar, there really wasn't clues in the market before even the sharpest fall in this currency pair. And of course, that fall was attributed to the much weaker than expected GDP. But before that number was even released, there were clues in the market that could have allowed you to risk a very little and to potentially make a pretty good multiple of that little. And by that, I'm going to now discuss some of the technicals that I use and to demonstrate, how that actually can take place. So if you look at this chart, the sterling versus the U.S. dollar on an hourly basis, and you look at the last 24 hours or so in the chart, I have a specific line in here. This is a moving average line, and this moving average corresponds with the 100-hour moving average. We're looking at an hourly chart. We're looking at sterling versus U.S. dollar, 100-hour moving average. And what do you notice here in this formation up here when you're analyzing the chart? What we can see here, actually over the last few days, is the market. You can go back to these points right here. The market initially came down, tested 100, had to move down to a new low, failed on that move, used that 100 as support. When we broke through the 100, we went down to a low, and we went down to, well, what do you know, a trend line that came in on the low. So we found support. And then look what happens at the 100. The 100 becomes the resistance level. So all these technical levels become levels where you could possibly risk a little and potentially make more than a little. For instance, if you see that the market is finding support here and move below here and then breaks through that the 100 again, you in essence can sell on the break of the 100-hour moving average in anticipation that the market has some move to the downside here. That is a trade that you can do. That is a low-risk trade. What is your risk? The risk is the price moves back above the 100-hour moving average before above that moving average line. And if it does, you're out. But if it doesn't, you actually get into the trade and the market moves lower. So let's just focus on this 100. You can do it again here. The market comes up to the 100, it moves down, it comes up to the 100, moves down, it comes up to the 100, moves down. And then we break through the 100 and we move higher, and we come down to the 100 and we test it and move higher. We come down to and we find support. We find support, but we can't get much support or much momentum to the upside. So what happens? The market breaks below and we go to the trend line and we come back above and today, as you come into the trade, if you're looking at the market in the Tokyo session, the market comes down to the 100-hour moving average, and what does it do? It bounces off that level. It bounces off the level one time. So that's bullish in the sterling versus U.S. dollar. So there's a reason to be long. But what else is happening in this chart? What we see here is that we have a ceiling here developing at around the 160.08 level. And although the price went above to 12 or so in the sterling versus U.S. dollar, could not maintain any momentum to the upside, and the market started to trade in between these two parallel trend lines here, 159.85 and the 160.08, and then broke through that level. And what happens here at the 100-hour moving average? The market breaks through the 100-hour moving average, and at the same area, we have this trend line coming up. So I ask you, in analyzing this chart, it seems clear to me that there is an opportunity here, an opportunity to take advantage of a low-risk trading opportunity where you can risk a little to potentially make more than a little. All right, we don't know how long it's going to go or how far it's going to go. We know that the GDP is coming out, so we know that there's some risks in the market on the potential of a move or some volatility as a result of the GDP. But putting that all aside, this is happening before the value, before the numbers are released, and the market has this opportunity you have this opportunity to sell on the break of the key 100-hour moving average, which has been a key level over 3 or 4 trading days here, and also below this longer-term trend line right here. So you can risk a little to potentially make more than a little, or in this case, a lot. And so what happens here? The market moves below the 100, and then the next target would be the 200-hour moving average. That's the green line in this chart. In addition to that, we have support at the 159.08 level, and the market has another decision here, and the market breaks through that level, and then we get to move down through the thing, through the economic data as a result of that, and the market moves down. So I also said before we talked that sometimes there are two types of luck I consider in the market. One is blind luck, where you're just buying and selling because for no specific reason, and another is calculated luck. Luck that allows you to take advantage of this move to the downside. And so a trader who before the economic release sees this development right here, turns the bias to the negative side, allows him to get in the market and have some sort of cushion before the economic number is released. If you were to sell the market at this point right here, and the market's down in this area before the economic release, you have, in fact, I think it was even lower, you have the opportunity to risk your profit for the potential for a greater profit. So in that case, someone may say, oh, he was lucky he got the economic release, but it was all created by what you did up here, by what you interpreted in the chart, by defining your risk and making that risk a small amount, and that allowed you to maximize your gain to make a more than small gain in your trade. And it was a clear trade that Carlos, when you asked if I was along the sterling versus U.S. dollar. I honestly said I was awake during that moment. But for someone who was awake, the clues were there to not be long. The clues in this hourly chart were clearly saying, don't be long. And what I often tell traders as well, and we'll get through it in a little bit in this presentation, is that you have to listen to what the market says. And the market was saying, don't be long, risk a little, potentially make a lot. Now let's go to the 5-minute chart here in the sterling versus U.S. dollar and see what that was telling us. I like to look at 5-minute charts, and I like to look at daily charts as well. And what this chart was saying is, remember that, well, let's go back here, and this 100 bar moving average on the hourly chart comes in around the 159. It looks like 60-ish type level. So in fact, it's 60, 61. And here's that line right here. Early in the day, the market came down to that 62 level on this on the first move to the downside in the Tokyo session, and bounced off of that level. So not only do we have the 100-hour moving average here, but we also had this low from earlier in the day. And you can see that for these hours here, 4, 5, 6 hours in this period right here, the market was very consolidated in the range. And if I were to look at my moving averages, which, by the way, they're the same moving averages that I use on the hourly chart. Blue line is the 100. The green line is the 200. If I was looking at this chart right here, I could see that the market was trying to find support against the 100-hour. In fact, we found it 1, 2, 3 different times. But we could not develop any momentum to the upside here. And when the market finally fell below the 100, notice that the 200 is along with it as well. It fell below both of those moving averages. Did that give you a clue to not be long the market, Carlos, and listeners out there? Of course, it said no. You should be short. And in fact, you should be short not only at the break of the 62 level where the market broke through the 100-hour moving average, but it was telling you to be short at as high as 159.86 when the price moved below these two moving averages and tested the moving average at this point right here. It is saying, don't be long the sterling. We tried that here. We failed up there. Get short the sterling here. At this point right here, our target would be to get through the 62 level. It did. It corrected up to it. It corrected down. It corrected up, and then started its move to the downside, when we went through the 200-hour moving average at this point, and it was Katie bar the door. It was all over to the downside here as the economic data came out. You can see here that this was saying risk a little up here. Your risk would have been from this point right here at around 86 to 160 level, 160.02, 15, 20 pips. What is and if you look at it as far as these boxes go, you're risking basically less than one grid box here from this point right here to the top of this grid box, which is on this above this by this red line right here. You're risking that amount of risk. And look, you make that a multiple. You make a multiple of that. You make a multiple of that. So you're 3 or 4 boxes into the win before the economic data even comes out and moves your way. So not only was the market telling you risk a little, but it was saying, we've got you can make more than a little, a vast sum more than a little on this trade, and that's exactly what it did. So, the rule number 2 is risk a little and make more, and you'll find yourself that you're making at the end of the year you're going to be more profitable and you're going to not blow up your account. Number 3, pick the low-hanging fruit from the tree when you can reach it, and this is a metaphor or idea that if there are some trades in the market that allow you to make a few pips here and there in non-trending type markets, maybe in quiet markets, try to pick it. Try to pick that fruit. Try to make these little gains along the way, or more than a little gains, where you continue to follow rule number 2, where you risk a little, but you're able to make some small gains along the way. And as an example here, I look at the sterling versus U.S. dollar yesterday afternoon's trading. This is in the afternoon session here, and we can see here that on the 5-minute chart here, the market had moved up to a high and came down to a low here at the 159.85 level. Market moved higher. It's in a more narrow trading range. It comes back down again to the 159.85 level. You can risk a little on a trade at this point right here. You had this spike low or a move lower, spike to the upside. You came down again, held that support, moved up to the upside here, came down again to 159.86. Held the support, moved to the upside. All these little moves add up to, some sort of profit in the trade. And then the market comes down once again, and eventually it moves through that 159.85 level and starts a little bit of a more move to the downside. But these are examples of low-hanging fruit type trades. You don't have to necessarily put a lot on them, but they add up in your account value. And if you have these opportunities where the market is, kind of non-trending, kind of giving you an opportunity to take advantage of moving average levels or key trend lines. The market comes up to this point right here. But take it. Take the opportunity to sell the market down. And although the gains may not be all that great, they kind of add up in your account. You can anticipate that the market probably is not going to go racing to the upside or the downside. Take some gains into your account. Accumulate them in your position, and they'll allow you to benefit more in your trading through 2011. Allow you to not blow up your account. The other thing that I often promote in trading is, and especially if you're going to try to increase your account value through the year 2011, is make an investment in your business. Make an investment in your business. We've gone through this idea of, okay, now you want to risk a little and make more than a little in your trade. There's also this idea that if you have a winner, what you have to think about doing is making an investment in your business. And there are certain ways that you can look at a market, that you can analyze charts, and that will allow you to make an investment in your business. And by that, what I mean specifically about making an investment in your business is that trading, first of all, is a business. Trading, if you don't think of trading as a business, you're probably taking the wrong approach to the market, to this idea about trading. And I like to parallel trading to other businesses as a result. If you are a retail business and you have some profits in your, let's say you're a restaurant, you have some profits in your business, what you're going to do is perhaps take some of those profits and invest in maybe a higher quality decorations or nicer linens or things that are going to really attract the kind of clientele that may allow you to, add a little bit more to your prices on your menu and perhaps have higher profits as a result, or perhaps get that better chef that's going to cook the better meals or have a better menu that allow you to improve your business as well. All businesses take part of their profits and invest it. They invest it in your business. And you too have to do it in your trading account when the going is good, when you have that inkling that, hey, the market does have a chance to not only move a little, but perhaps move a lot. And as an example, I'm going to be looking at the euro versus US dollar, and this is actually yesterday's trade in that currency pair. And what I want to start off by taking a look at this PowerPoint slide, and then we'll go to the live market, and I'll manipulate some of the tools that I use that will allow you to make an investment in your business. And from this chart right here, what we're looking at here is the move off the bottom in the euro versus US dollar. And you can see here that the market initially had some trouble moving above the 200-bar moving average, came back down below, but then we started to make a move to the upside. So if you're looking to get in the market at this area, and it also was corresponded with the ceiling here in the market, that's why the market initially moved up. It was coming off a nice low moved up and then had some congestion problems. But the second time it broke through this ceiling here and through the 100 bar moving average on the 5-minute chart is when the market started to gain some momentum. So there's a reason to think that there's an opportunity here to invest a little in the business or to invest in a position and have the market move higher. Now, we all know that markets don't go up in a straight line, although it does seem like it did in this point here. But typically at the beginning of a trend, what you'll notice here is that the market goes higher and then it corrects down. And on the correction to the downside, we actually came below the 200 bar moving average. But looking at this, if you're long at this point right here, and you see the market move to the upside, but you also are a little bit more confident. Why? Because the market moved above this floor, this ceiling level here. We moved above the 100. The 100 bar moving average is starting to go sideways. Risk is defined against the 100 bar moving average. Risk is defined against this ceiling right here. And a strategy that I like to do at this point as well is use another tool in my trading, and that tool is a Fibonacci retracement. And you can see here I put a Fibonacci from the low to the high here, and I outline, oops, I hit the wrong button there. I want to go back there. And I outline the 38.2% retracement. I also have this low here against the 100 and against this old ceiling here. So I have good support here. Now, as a trader, what you have to do at times is if you're long at this point and you're risking just a little move, maybe you risk to the new low right here, which isn't a lot of risk. At times when you're a trader and you have a profit in your business, in your account, what you have to do is stay with the position and invest in your business. Anticipate that the market is going to go higher, that you define your risk here, and at the very least you're going to either break even or make a few pips on the trade, but you're confident in your location of your trade, you're confident in your position. It's time to make an investment in your business of trading, because we all know that even if you got out at this point and made this profit, the chances are you're not going to get back. It's going to be harder to get back in the position and allow it to really benefit in your favor here. And so when I say invest in your business, if you feel that you have great trade location or good trade location or good to great trade location, make an investment. Put a Fibonacci in. Define your 38.2% retracement. If the market is really bullish, if the market is going to make a move, it's going to most likely hold that 38.2% retracement. And if it holds that level, you have the potential for a sharp, a continuation of the trend. I've seen it time and again. The market likes that Fibonacci retracement level, the 38.2, and if it holds it, it tends to move higher. So invest this amount in your business, not just this amount, a greater amount in your business. And if you do that and the market holds a 38.2% retracement, you're not the only one who sees it. Everyone out there else will see it, and they'll start to force the market to the upside, and you'll get this type of move. It didn't come off of data. It came off of just the market moving to the upside here, getting caught, squeezing shorts, and moving the upside. Now, I'm going to take the camera off here. I'm going to go to the live chart and look at that the market and show you exactly what else you can do here, just to show the point and then give you an idea of where how to interpret the market. So you should see the 5-minute chart here in the euro, and this is yesterday's trade, and this is the Fibonacci from the low to the high. We invested in the business. We held the 38.2. And the market started to move to the upside. Now you ask, okay, what do I do now? I'm in the long position here. Do I stay? I had this nice sharp move to the upside. Do I stay in the business or in the position, or do I get out? And what I like to do at this point is I'm going to move my Fibonacci up to this new level, because again it's spiked to the upside, and I'm going to actually move this over here so you can get an idea of where these levels come in here. Move it here. But you can see here that on the next steep move to the upside here, you see the market peak at the top, and I put my Fibonacci now not from the low of yesterday, but from the intermediate low from yesterday, and moved the market to the upside, and I defined again my risk. My risk of my investment in the business what am I going to risk on this trade? And I can risk this amount, which is 38.2, and it goes down to 136.29. And what does the market do? The market finds support against the 29 level. Once it sees that, it starts and it takes the next leg up to the upside. So in a trending market, in a market where you have good trade location, invest in the business and see what actually happens here. Now, if you move it up to this point right here and take a look at the next level, your 38.2 comes in at 136.63. The market comes down to that level, although it broke 2 pips to the downside, went up, made a double top. When next time it moved through that 63 level, the market was over and the market started to move to the downside. So invest in your business. Look for opportunities to invest in your business, and it doesn't necessarily show you that it doesn't necessarily stop you from blowing up your account. It allows you to grow your account, but it certainly allows you to follow along. And I'm getting a comment that hindsight is the third piece of luck. Yes, hindsight does come into play, but if in the way that I look at the market, Boyke, is that I use the same tools, and the tools are either going to give me a bullish or bearish bias. So at this point right here, when the market moved above the 100 bar moving average, it does not say go short. Okay, it says go long. When the market, and I use Fibonacci retracements, when the market does not go below the 38.2% retrace, I know you're joking, but some people, a lot of times when you do these analysis, there is a hindsight that comes into play. But what my point is, if you use the tools and you're consistent with the tools that you use, and I use 3 tools. I use moving averages, I use trend lines, and I use Fibonacci retracements. What you will find is that the hindsight that you have is that you actually have foresight as to where the market direction is. And if you know that the bias is bullish and you can define your risk, you're in a better position to stay on that trend. And if you can define where you should get out below the 38.2% retracement, you're comfortable with that position, and that's what allows you to take advantage of these moves to the upside. So I appreciate that comment, because it allows me to talk about that type of question. Looking at the euro versus U.S. dollar here today, to highlight the 38.2% retracement. If you take this most recent low to the high, what happened here at the 38.2? We found support against the 38.2% retracement, and that helped contribute to the move to the upside. Notice here that the quadruple high as well also helped here in this market. The market's very choppy here today, but use those 38.2% retracements and see how far they can go with them. All right, let's move on. I'm going to take off the screen here and move back to my PowerPoint. We have a few more here to get through. Number 5, park part of your. This is another way to prevent. This is more of a way that you can prevent yourself from blowing up your account. And number 5 says park part of your intellectual ego at the door. Park part of your intellectual ego at the door. What I mean by this is that most people want to apply a fundamental approach to the market, and why? Because when you talk fundamentals in any sort of market, turn on TV, you listen to all the people on Bloomberg, on CNBC, they're going to talk about fundamentals. Why? Because it makes them sound smart. It makes them appear that it makes them feel smart. So number 5 again here. Let me go back to it. There, part of your intellectual ego at the door. Again, people like to sound smart when they talk about trading. People like to know the reasons why the market is going higher, why the market is going lower. Today's move up in the euro versus U.S. dollar, I could not find a reason why the market went above the 30. When it went above the 37 level, it went all the way up to the old highs. There was no necessarily news in the market that said that the euro dollar should go higher at that point. People if I were to rely on my fundamental perspective, and in fact, just prior to the market squeezing to the upside today, what came out? We had better consumer confidence. I think it was the highest level in 8 months or so in that consumer confidence number, and you would expect that the dollar might get stronger off of that number. That's a fundamental reason. That's an intellectual reason that would say that the market should do this. But what I often remind traders is that you don't want to rely on that fundamental reasons for why the market should go up or down. You always have to it's okay to have that fundamental reason, but what you have to do is use that as a secondary tool and instead rely as a primary tool the technicals, because the technicals are going to tell you whether the bias is bullish or bearish, as I demonstrated in the last chart, moving above things like the 100-bar moving average, holding 38.2, and so on and so forth. So in this chart, I remind people that when you start to hear yourself say and believe things like gold is going to move higher or lower, so the dollar is going to do X, Y, or Z. Notice how gold's been going down, and by the way, the dollar's been going down at the same time, which is unusual, or it isn't the same story that occurred for the last few years when gold prices were coming down. The dollar was going higher. Now we had seen in January that gold prices were coming down while the euro was rallying, the dollar was getting weaker. So that whole relationship was divorced. So that's a fundamental reason that you don't want to really rely on. When you start saying things or believing things like Ireland, Greece, Portugal, and Spain point to a lower euro or a higher euro or whatever, try to park that ego at the door. Try to rely less on that fundamental, rely still on the technicals. When you start to say to yourself or start believing that things like QE2 will lead to lower rates and the lower dollar, well, what happened when the Fed announced QE2 in November? Interest rates did not move any lower. They started to move higher. At the same time, the dollar did not move lower at the time. It started to move higher. So you can't necessarily believe or start to apply those fundamental principles to the foreign exchange market. You are going to find that you are going to have those blow-up trades more often. Why? Because you cannot define your risk when you rely on fundamentals. In technicals, I can define my risk by applying the tools that I use. Moving average, price moves above the moving average, I'm out of that trade. Price moves below a moving average, I'm out of that long trade. Those are able to define your risk. A fundamental reason to go long or short the dollar because gold is doing this, Ireland and Portugal are doing this, or QE2 is going to cause this to happen, does not define your risk. So do me a favor, park that ego at the door. Don't rely on your intellect necessarily to do trades. It's okay to have a fundamental perspective, but always, always, always consider the technicals as your key tool, and don't blow up the account by relying on the fundamentals. Number 6, listen to what is being said, not to what you want to hear. Listen to what is being said by the market, not to what you want to hear. And by that I mean the market does talk. It talks to you in the form of the price and the tools that are applied to that price. So you have to start to listen to what the market is saying and believe in it. Case in point, the dollar versus yen here. For a second, looking at the daily chart, we're looking at the 100-bar moving average. Although the price was moving above and below the 100 here, at this point right here, it started to say the market is more bearish. Why? Because the price is staying on the downside of the 100-day moving average. So what happened over subsequent days? At first, we had a move to the ups above the 100-day moving average. It moved down. It closed below. The next day, we had a smaller move to the upside. The market could not sustain the move above it. The market moved lower. The next day, we used the 100-day moving average as resistance, and the market moved even lower yet. And this day, the market couldn't even get up to the 100, and the market moved lower. And then we had this day where the market sold off below 61.8, below the trend line. It was telling you, the market was telling you, and pleading you to listen to what it had to say, and it was saying sell, 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 sell. And if you did, the market moved down. It also was telling you at this point right here to listen here because we had a nice little trend line here, a nice little channel trend line here. So it was saying buy, and so you could actually buy and sell against what the key technicals were telling. Listen to what the market has to say. It tells you things. What happens here? The market breaks below the trend line here, and it closes below that line. What should the market do? It should sell off. But what happened the next day? The market found support against a 61.8% retracement, couldn't take out the lows. So what's it telling you here when the market breaks above this trend line? It's telling you buy. And that's what the market did. The market bought all the way up and failed up here, or found some sellers up against here, failed, moved down, failed again and moved down. Right now the dollar yen's in kind of a narrow trading range, but yesterday it started to revert to this idea right here, sell against the moving average line, and the market did in fact move lower against that 100-day moving average. So listen to what the market has to say. If you do, you're going to find yourself you're better off. By the way, this is an addendum to that rule. The market is deaf. That is, the market does not listen to what you think it should do. So don't try to tell the market what to do. This is another way of saying that your opinion does not necessarily matter to the market. What you have to start thinking in terms of the analysis and how you're going to trade the market is, what is the market telling me, not what you want to tell the market. So if you think that you that the market or the euro is going to go up or it's going to go down, that's good. Have a reason, have a technical reason for why the market should go up or down. But if it doesn't do what it should do, that is, if it doesn't go in the direction that you think the market is, or that you think the market should go, and let's say you want to go long the euro and it breaks below a key moving average line, a Fibonacci, a trend line, get out. Listen to what the market has to say. Don't try to tell the market what you want it to do. You will never win in that game. You will blow up your account. Number 7, if you're out of rhythm with the beat of the market, do yourself a favor and don't dance. If you're out of rhythm, don't dance with the market. And here's an example of sterling versus US dollar. In this section right here, we have a nice, the market is nice and calm here. We go above the 100, we can't sustain it, we move back below, we go to the 200, we come back up to the 100, and it moves back below, we go, and all of a sudden, what happens here? The rhythm of the beat of the market just goes crazy. Does this look anything like this? No. And what you have to realize is that when the market moves all the way up here and comes all the way back down here, a nice break to the upside, and fails and corrects over 100%, guess what? You're in the type of market that you don't want to be in. You want to avoid these types of markets. If you can't dance the dance, don't dance it, all right? Don't be that guy at the wedding who dances crazy. Be the guy who's in rhythm, in step with the market during normal market relationships. But if the market is doing this, stay away. Stay away from the market. In fact, today's trading in the euro, you might say to stay away from that. We're currently trading at 136.21 after going up to 80, back down, up and down a number of different times. The rhythm of the dance is too fast for me. I don't know about you, but I'm not necessarily dancing here today. I already learned my lesson. Was stopped out on a few trades. Number 8, we're getting to the end here, is that in order to prevent yourself from blowing up, you do have to learn to fish for yourself. You do have to learn to fish for yourself. The time is come, although we try to educate and try to tell you ideas or ways that you control your risk, what myself and Sean and other analysts are doing is not necessarily specific toward you. Every trader has their own fingerprint. You have your own economic situation. You have your own bills to pay. You have your own risk tolerance. You have your own you may have your own reasons to trade, and although I've given you reasons and ways that you can follow the market, maybe you have your own. Maybe you don't like to look at the 100-bar moving average. Maybe you like to look at the 55-bar moving average. I don't necessarily care, but what you have to learn is the techniques of trading, those techniques that I've shown you or tried to demonstrate here today. If the market breaks above a moving average, the bias is bullish. If it holds a 38.2, the bias is still bullish. And if you follow these rules, whether it's a 100-bar moving average or 55-bar moving average, you have to do it yourself. You have to learn to fish for yourself and not rely on other people. And the more people that you listen to out there, you could get in trouble. It's okay to rely on certain people who fish the same way that you do. But if you find that an analyst is out there who doesn't define risk, don't listen to him. You can't afford 300 pips in your account. Most people can't. You can't afford 200 pips to your account. Most people can't. What you have to do is prevent those blow-ups. Be comfortable with what you are doing. Make sure that you learn to fish for yourself, that you're able to take advice, that you're able to educate yourself. But when you get to the point where you're relying on those people 100%, you don't necessarily want to do that. You want to maybe get their advice, see where the bias is, bullish or bearish, but then define your own risk and do your own trades. Learn to fish for yourself. Number 9, don't look for a bar fight. You end up getting bloody. And by this, what I mean that is, if you don't have is that too many retail traders will take trades that are very risky. They will get into trades that are going to get them into a bar fight, and anything can happen in a bar fight. You just don't want to get in those positions where you have the opportunity to really get yourself hurt, okay? To really have that one sucker punch come that you didn't expect that gets in the way of your face, and you don't want to do that in trading as well. So if for example, you are coming into a key economic release like unemployment, don't trade if you don't have a buffer, a profit buffer. If you're going into the GDP number today with the UK in the sterling, and you didn't have that profit from the 100-bar moving average of the 5-minute chart or the hourly chart, don't get in that bar fight. Wait for the number to come out. Even if you miss the the move, you cannot necessarily predict that the market was going to do what it was going to do at that point. Risk is increased. If risk is greater, like before a key economic release like GDP or unemployment, don't go and look for a fight. Don't go try to predict the market. Wait and trade the market after it. The other thing that you should always do is if you risk more than 3 and 5% is like so above my max. I really risk less than 3% on any trades. You are looking to blow up your account. If you think that you can go in and risk 10% on a trade and survive in the longer term, you're not going to be able to do it. You have to be consistent. You have to risk less. Most money managers out there will risk 3% of their equity. The reason why they make more money is because they have much larger equity than you do. If you think that you with your $1,000 account can triple or quadruple your money by risking 10, 15, 20% on your account, you will not be able to do it. You have to risk 3 to 5, and slow and steady wins the race. Another warning, that is, if you trade high-flying cross-currency pairs that have a larger bid-ask spread with volume, with a larger bid-ask spread and have more volatility than, let's say, the euro, you're looking for, and you trade the same amount in that currency pair, don't. Trade less. All risk is not the same. Sterling yen might have more risk than the euro versus US dollar. If it does, trade less. Risk is not fungible across all different currency pairs. Recognize the risk that you're taking. If you want to risk the same amount that you in the sterling versus yen that you would in the euro versus the US dollar, you're looking for a bar fight. You're looking for a big loss. So in general, what you have to do is use common sense. If risk is increased, you have to you have the potential for a larger loss as well. Don't look for that bar fight that's going to allow you to lose a lot in your account, that allow you to blow up. Be smart out there. Use your common sense. And the final rule that you should understand as far as your trading goes in 2011, if you do blow up, you only have yourself to blame. There are plenty of ways that you can avoid blowing up your account. Make sure you follow them. Make sure that you are disciplined in what you do. Make sure you define your risk. Make sure you listen to what the market has to say, not what you have to say. Make sure you park that fundamental ego at the door. Use it as a secondary tool, not a primary tool. Follow what the tools are saying. If you do all these things, don't look for the bar fights. You're going to be okay with your trading. And if you blow up your account, you're the one to blame, folks. It's all you. So make sure that you follow the rules, and you'll be okay. So there you have it. That'll take care of my 10, rules or 10 ways that you can keep yourself from blowing up. Some of them were there to keep yourself from blowing up. Some of them were there to allow you to enhance your profit and in your account by doing things like invest in your account. If there are any questions, I'd be happy to answer them. We have about 6 or so minutes. Just type them in, and I'll be happy to answer them. But thank you very much. I see great advice for sure. Any questions? If you want to look at any market charts as well, I'd be happy to look at them as well. Any currency pairs? Someone must want to look at a currency pair. The Swiss, dollar Swiss. What have we seen in the dollar Swiss? We have seen a flight to quality within the into the Swiss franc here over today. In particular, why? Because the GDP was much weaker. People are thinking that we have U.S. GDP coming out on Friday. Maybe we're going to see the same thing, and that will cause a flight into the Swiss franc. The other thing that is happening within the Swiss this currency pair is that the central bankers started to talk a little bit about how the Swiss franc the strength of the Swiss franc is going to hurt exports, and that is a worry to them. And oftentimes the market will the market will try to position or try to tempt the Swiss National Bank to intervene in the market. So you see this little move to the downside. You get any sort of bearish sentiment, and the market will also start to move to the downside. But that's all the fundamental news that goes along with the Swiss franc and why it's doing what it is. But from a technical perspective, which is our primary way of analyzing the market here, we do have this channel trend line on the top and a parallel trend line that I put on the bottom. And you can see that yesterday the market and today the market tried to hold that support. The problem was we did run into resistance here. And anytime that you have a support level and you think of that the market may have an opportunity to move to the upside, you always have to get through the next target. And if you get through the target, which would have been this low right here, it's an obvious target here that the market needs to get through, and it doesn't get through, the market's going to move back down. That's why we saw this move to the downside when the dollar started getting hit with the euro moving higher here. So did the dollar Swiss. But right now, what we're seeing here is that the market is right on or just below this channel trend line, and I like to keep it in there to keep the integrity of it, especially when you get these fails here. And if the market should move back above the 69 level here in the next hour or so, I would expect that we do see some short covering in the dollar versus Swiss. And you would know that you're right if the market gets above the 84 level. That is a 61.8% retracement of this recent move to the upside. That is the level, the bogey that the market has to get through. Next target is to get through the 95.20 level. Two moving averages are 100 and 200, and they're simple moving averages. Simple moving averages. I always use the blue, and the green is the 200. I get euro versus U.S. dollar. Let's see what this is doing now. Like I said, this is looking like one of those currency pairs that's in a bar fight. Today, I'm not all that enamored by its action here today, so I have to be a little bit more, I'm a little bit more cautious. If I'm going to trade, I'm going to trade less, okay? Less of the amount here in the euro versus U.S. dollar. But clearly let's go to the hourly chart. 1, 2, 3, 4, 5, 6, 7 different times the market's gone up to this 136.86 level and held the level. Okay, that's the bullish side. On the downside, 1, 2, 3 different times the market came down to 38.2% retracement of this move to the upside. That's the bullish. That gives it a bullish bias. Let's go to the daily chart. If you look at the daily chart and you take the move down from the November high down to the low. The 50% comes in at 135.77. That is just 2 pips off of this 38.2. This is 135.75. This is 135.77. So we have 50% of this move, 135.77. 38.2% retracement of this move, 135.74, and the market has found support against that level. So now with the market price currently in between resistance and in between support here, what do I do at this midpoint? I don't know. I'm not all that thrilled with it. So let's go to the 5-minute chart, see if any clues are coming off this 5-minute chart. And what we can see here is that the market moves sharply higher, moves sharply to the downside, move below the 200, move below the 100, is back above the 100, and testing the 200. If you want to be, from this perspective, I would think that, well, I guess you have to be long. We could not, we didn't go down toward the 77 level. My stop is here at the 136.16 level. That's a 38.2% retracement, also the 100-bar moving average. Do I want to risk the 17 or 18 pips that I have to do right now? Not necessarily, not really all that keen on it. This type of market, so you say, okay, well, what's my longer-term perspective on the euro versus US dollar? Well, when you see this type of move, it's saying the market doesn't know, and so I don't know either. So I am looking for more calmer markets, clearer direction. What I do know is from the hourly chart that if we break above the highs, we should go lower. If we break below the 38.2% retracement, or if we break above the highs, we should go higher. If we break below the 38.2 and this 77 level, we should go lower. That's almost a better trade than anything in the middle right now. Okay, dollar versus yen is down. The bias is to the downside. We're below the 100-day moving average. We keep on having lower lows here. The market failed above on the move to the upside here on this spike high as a result of the consumer confidence number. Market move below the 52 level. I'm going to be using a stop above the 52, 53 level, 100-hour moving average. It would be my risk. What we need to do is have it go through the 61.8, which is testing right now, to move lower. So this, unfortunately, is the risk right now, which may be a little bit too much. Well, it's not that much. 33 to 52, that's 19 pips. But in the land of the dollar versus yen, it's a lot of risk here in that currency pair. So you have to be you have to make sure, especially with the narrow trading ranges that we have. So I'd be a little bit more, patient on the sale. But this is a key support level here for this currency pair we're testing right now. Trade less. Yeah, trade less. If the risk is increased, if the volatility in the market is increased, if the risk is increased, and you feel that, and I feel it in the euro. I mean, I can't help but feel it in the euro. Then trade a less amount. Risk isn't all the fungible. Risk isn't the same every time. So wouldn't you say that for us small individual traders, the safest approach is to wait at point of supply or demand level and take the trade, risking 3 to 5%. I took the euro at 128.90 on January 11th, and holding and looking at the charts, stop relocated already. Yeah. I mean 3 to 5%. It depends. If you do, if you're risking 3 to 5% and your account is 10,000, you're only doing minis or micros or whatever, then you have a lot of room to maneuver the market. But you still have to make those gains. If you're going to risk 200 pips or so on a trade, you still have to make sure that you make another thing going. So I'm done. Thank you very much. FX Street. We'll talk to you all later. Bye-bye now.